And one other thing that you mentioned that was a big part of my journey as well was, like this infinite banking thing where, you're going to get rich by buying cars and going on vacations and stuff like that. And what that says to me is, like, for me, that's mainstream financial media philosophy entering into the infinite banking space and whole life insurance, where we're putting so much faith in the financial product itself to solve all of our problems. So when I hear somebody saying, hey, you're going to get rich by going on vacation just because you set up this policy, you're just, now all you're doing is you're hoping that this financial product is going to solve your problems and make you rich. It's probably not going to do that. Right now, with whole life, you design them right. They get a safe internal rate of return, 3 to 5%, whatever. It's nothing sexy. Can that turn into a decent amount of money over a long period of time? Sure, that's how compound interest works. But you have to, one of the big things, light bulb moments again for me in my journey, kind of a benchmark moment, is that we are our greatest asset, not the whole life insurance, not the 401k, not the IUL, whatever it is that you're using. It's us. We're the ones that make the income in order to put money and deploy capital into these various different products, take advantage of them and all their benefits. We're the ones that do the research and increase our financial education. Like, we are the greatest asset that builds true wealth in our life. Do financial products have a place? Sure. But if you're just going to put all your faith in the concept of achieving your financial goals in one specific financial product, and then I'm just going to use that to go on vacations and buy a bunch of depreciating assets and I'm going to get rich, man, that's one of the things that I just tend to push back on a little bit and try to get people to realize that we are the greatest asset. It's not this financial vehicle. This financial vehicle empowers us to be even greater in our lives. And I'm a personal testament to that when it comes to dividend paying whole life insurance, because it's been an absolute game changer in my life, implementing things like infinite banking. And I just think to myself, had I not started questioning things, right? Had I not started running numbers for myself, had I not started to ask myself, okay, is there a better way to do this than what I'm being told by traditional financial media? Okay, well, that set me down a whole new path where I found all these different tools and strategies and different mindsets as well, different ways of, like, it completely changed the way I think about money. And it's been an incredible journey. It's been super powerful. And that's why I got into the business, because I wanted to share how amazing this stuff can be for the right people. It's not for everybody. And then also to expose some of the stuff that is a little misleading out there. It's just people are misrepresenting a lot of different things, not providing accurate information. Therefore, we can't make informed decisions. And I have a real problem with that. So it's really just about, for me, exposing or just showing that, hey, there's other ways to do this game called personal finance. Here are some different options. Do your own research, then make a decision. Right? That's it. So those are some of the big pivotal moments for me. The shifts in mindset were some of the biggest ones, and like running the numbers myself, man. Like you start doing that, and you start to realize that this stuff can be really, really powerful.
Yeah, totally. I love a couple of things you talked about in there. It made me think back to my early days where it was all about the rate of return in the policy, and that it was almost like this idea that you could like get rid of all other financial instruments, all other financial tools, and just devote everything into whole life. And it's like,
Right.
no, 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 no. Like,
Nope.
this is a part of your portfolio that serves a very specific function. It's a very efficient tool that can serve a lot of functions.
Mm-hmm.
And it's not replacement for 401k. I see stuff on Facebook ads all the time, and it's utilizing the index universal life insurance policy, which they a lot of times will kind of compare to a whole life insurance policy, and saying, get rid of your 401k and put it all into an IUL, right? And
Right.
I kind of came from that camp of, that was even the case with whole life, of like, you can just basically take all of your retirement, get rid of the stupid stock market, get rid of all the volatility. You don't want any of that in your life, and you want to put it all into whole life because it's the best product in the world and you need to buy it. Yeah. And it's like, no, there's a balance here. You still have a portfolio. You still need to have a growth element to your overall portfolio. Now, does it have to be stocks and bonds? I think this is where you and I definitely have created content around before, of thinking differently about that, of there's multiple ways to grow money other than just handing it over to the stock market or a mutual fund or your advisor.
Wall Street.
Yeah, exactly. And letting that be, the hands off, oh, I'm going to wash my hands of it. I have no responsibility to this. And I hope that it gets me where I want to get to when I need it. And there's a lot of ways to do that. You've got great content on your channel about your personal journey of what you're doing in the real estate world around that, and doing some hard money lending. And there's other ways. You've done some equipment flipping, right, Matt? So, there's other ways to go about it. You can have a business and invest in your business. If you invest in your business, you can have a big return on money. Obviously, there's no guarantees there, but there's no guarantees in the stock market. And this is something that one of our mentors, Garrett Gunderson, talks heavily about, is identifying what he calls your investor DNA, figuring out what ways are going to align with you to grow your money. And then in the part that's not to be emphasized on growth, what do you have that's safe and secure, dependable growth? That's where whole life insurance can fit in that part. In Tony Robbins' book, Money Master the Game, he talks about, and as he interviewed, like a dozen or more financial gurus, Ray Dalio and some of these really big name guys that created companies like Vanguard and all these huge, Charles Schwab and all these big companies. They all pretty much concluded that you want to have the 40-60 portfolio, 40% in bonds and 60% in the market. That's like the ideal scenario. And so in that split, okay, well, the 60%, let's have that be in a way that aligns with you and is growing your money that you feel good about, you feel safe about, it aligns with what you're wanting. And then the other 40%, not that all 40% has to be in whole life insurance, but there's some advocates for that. David McKnight, he's an advocate for that. Tom Hegna, he's an advocate for that. You replace the bond portion of your portfolio with cash value life insurance, because the life insurance company is better at investing in bonds than your broker, better than your advisor. They've been doing it, at least the companies that we use, they've been doing it for over 140 years or 120 years, like maybe from the lower end. So they know how to make money predictably through the recessions, through the Great Depression, through world wars. They know how to be consistent and stable. Whereas your advisor, he's maybe been in the game max 40 years if he's been around for a while, and he's an old guy, and, he's got a lot of experience, but not as much as the life insurance company. So if I'm looking for a place to put the safe portion of my portfolio, I want that in the life insurance company, because they know what to do. And I have that part of my portfolio that needs the certainty, that needs the confidence that this money is going to be there no matter what. And the growth is going to be there no matter what. It's guaranteed. It's a contractual obligation that they have to me as a policyholder, that I know my account value is going to go up every year. And even if the stock market goes down 30%, I can wake up in the morning going, hey, I know this portion of my portfolio is going to continue to grow today because the people managing that part of it, they know what they're doing, and I don't have to worry about that. So I think that was a big shift for me in understanding, zooming out. I am a financial strategist. That's one of the things that we do, is understanding, the bird's eye view of our finances, because we get so zeroed in, so siloed into, here's our savings and here's our retirement fund and here's our college fund. And they're all diversified out almost to their own detriment, to where you don't have enough money working together. It's not a synergistic system of finance. It's all segregated to where you can only put so much money in any one individual account, and you're hoping that rate of return is going to solve your problems for you in a lot of these accounts, whether it's your retirement accounts, your investment accounts, your 529s for your kids. You're hoping that the rate of return gets you across the finish line. And that's not always going to do that for you, because it's about timing, it's about risk. So having the other part of your portfolio with whole life can balance that out, because we want to have risk and we want to have dependability. And for everybody, there's got to be a ratio for that. But I know in my time in the industry, most advisors tend to weight clients more heavily on the market. I was working with a client a couple of weeks ago that they're over 70% allocated in the market, and they're already in retirement, which is like, no. And this is a very, very, very conservative person that's done very well by the book, doing it as the way you're taught. You scrimp and save and sacrifice and delay. And she's done that very, very well. And she's done very well for herself. But now the balance isn't congruent with who she is. And she has an internal struggle now, because her advisor has put her in this, category of, I got to have all this money at risk because I got to keep growing my money. It's like, no, now we need to shift our thought process to income. Now you need to dial in income, because in a few years, you're going to have RMDs, required minimum distributions. You're going to have a plan for that. And we don't need to keep growing money. We need to shift and start planning for income. And that's where one of the things with whole life can come in, is it can be a buffer during your retirement years. So in the years that you have your portfolio that's invested in the market. And I'm just going to speak to that because that's what most people have. Guys like you and I might have it in a business. We might have it wrapped up in real estate or equipment financing or all kinds of cool stuff that, we think outside the box. But most people, are going to be doing it the old fashioned way, the traditional way. And when the market goes down and you don't want to have to take money out of your portfolio for your income in retirement the same year that the market also went down and your portfolio balance dropped. That's a double dip against you. That can really hurt you. It can really put your account value at risk to be able to be with you for the the duration of your retirement. And that's something called longevity risk. If you outlive your money, you have to become a greeter at Walmart again. And that's where people don't want to be in that situation, but their portfolio doesn't have enough balance on the safe side to weather the storm. And there's not a strategy. This goes back to financial strategy. A strategy for, okay, when the market goes down and I'm needing income in retirement, oh, and guess what? There's inflation, so I need more money in my income for retirement. But the market also went down. What am I going to do here to balance that out? Oh, I've got a whole life insurance policy with cash value that I could borrow against that. There's no tax implications until you reach basis, which is the amount you put in. If you've pulled out all the way up to that, anything above that would be taxable. Anything below that is not taxable. You could do that and you could weather the storm a year or two in the down market, let that balance come back on its own without selling shares for your own income, let that come back. And then you can put the whole life kind of back on the back burner again, knowing I have that if I need it, but let's go back off my investments. And that is something that I didn't understand early on in my career in life insurance, is that there's that power in whole life insurance, that it's what we call a volatility buffer in the industry. It allows you to weather the storm financially. And, when you talk to the average person, they've never even heard of a concept like that. They've never had an advisor sit down with them and fill that gap. And there's a lot of other gaps that come in a financial plan that I'll get into, but I'll turn it back over to Matt. If you have any other thoughts on that, I'm sure you do.
Oh yeah. We could talk for hours on just that segment right there, but just a couple of things really quick. Jeff, I think this is why increasing financial education is so important, and taking responsibility for our personal finances again, versus just handing it over to the financial professional or Wall Street or, your 401k and then crossing your fingers, hoping everything's going to be fine. But we don't even consider the distribution phase of that strategy, right? Which is totally different. It's like a complete 180 difference than the accumulation phase of building wealth. Like, do you have a plan? Well, like when I hear that somebody is in retirement and still has 70% of their portfolio in high risk assets, what the heck are you doing? So it's just about rate of return. It's just about growth. And is this even the best vehicle to create income? There's a very big difference between growth and income. And oftentimes the vehicles that provide the most growth are not very good at providing income, and vice versa. The vehicles that are good at providing income aren't very great for growth. But that doesn't mean that one is better than the other. They work together. Okay. And that's like, as you start to go down this rabbit hole, learning about how cash value whole life insurance works, then you start to realize that, holy smokes, this actually adds fuel to the fire in a good way for my retirement, because it serves as that safe asset during retirement that I could tap into as a volatility buffer if I want. It allows me to more freely spend my assets. Maybe because I have a whole life policy in my portfolio now, I don't have to stick to the 4% rule. Maybe I could do 5 or 6% conservatively, because now I have this policy over here that's going to be passed on to my spouse, my kids, whatever, as a legacy play. I don't have to worry about spending all of my assets, so I have nothing to pass on to my wife, kids, etc. Right? So, like, when you start to think about it that way, it's like, holy smokes, this thing actually can make things even better. Right. Not to mention, so I actually did a video on this earlier today, or I mentioned it in a video that I did, Jeff, talking about, it was a video about determining if dividend paying whole life insurance would be a good fit for you or not. And one of the things that I brought up was, if you get excited about high yield savings accounts, because interest rates have been pretty high, or like high yield treasury bills or high yield bonds, like things like that, you're probably a good fit for whole life. Not everybody, but pretty close, because whole life is a very good bond alternative, alternative savings account, if you will. where, because we have the guarantees and the dividends, which are not guaranteed, but these companies have always paid them, they typically net 3 to 5% tax-free compound growth for the life of the policy. Like, you're getting a much better bond. And what's really bizarre to me, when I get comments from people, or people say they hate whole life, yet they have a 60-40 portfolio, 40% bonds. Well, if you like bonds, why don't you like whole life insurance? I'm confused here, because this will, the internal rate of return of these policies, when you design them correctly, they'll get similar to what your bond portfolio does without the risk. And plus, you get so many other benefits as well. Now, are there pros and cons? Of course, you're buying life insurance, so you're going to take that little bit of a hit in the first couple of years before you get back to break even. It is what it is, right? It's give and take, okay? But, that's why the financial education part and doing your own research is so important. Weigh the pros and cons of these different things and then make a decision. But if you don't even know that whole life can do this for your portfolio, how are you supposed to make that decision? What if one simple change in your portfolio, like adding a whole life policy, meant the difference between outliving your money and not? Or how about this? How about whether or not your retirement is extremely stressful financially because you're constantly worried about what the stock market's doing, versus I sleep pretty good at night because I have a well-balanced portfolio here. I've got my safe money over here. My legacy play is taken care of. Market goes down, I could tap into that if I need to. I'm good, right? Like, how about the peace of mind aspect of this as well, right? So
what's up, my fellow wealth creator? Thank you so much for checking out this clip from the Millennial Wealth Creator podcast. If you'd like to watch the full podcast, there will be a link down below in the description. Make sure to also check out the additional tools, training, resources that I have in the description as well, just to help you along your journey. Thanks again for checking out the clip, and we'll see you in the next one.